I published earlier today a new blog post discussing most of my trades over the past few days. I have a link to that blog in my YouTube profile section for anybody interested. Just click Southgen and you'll see it. The most significant change was selling 20 corporate bonds, $1,000 par value bonds that have maturities mostly in the 2032 to 2035 time period. I'm only slightly reducing my interest rate risk by lightening up on those longer maturity corporate bonds. My average weighted duration of my corporate bond portfolio, which is extensive, close to 400 different corporate bonds, is about 3 years. So I've reduced that maybe a tenth of a year by selling those bonds. All of those bonds were bought recently this year at discounts to par value and were sold at premiums that netted a $479.50 profit. Snapshots are in my blog post. Also bought 26,000 in treasury bills at auction and was a net buyer of dividend paying common stocks. I may slow down my T-bill purchases over the coming weeks in response to the lower yields on those T-bills that I'm expecting now. I still believe that both bond and stock investors are underestimating the odds of a resurgence in problematic inflation. The stock market is rallying today based on the CPI report released by the BLS. To the extent that the rally is rational, it is probably based on CPI not rising as much as feared by stock investors. Annual CPI for the 12-month period was reported at 2.7%, and that's for the 12-month period ending in July, which was unchanged from the 12 months ending in June. Core CPI was up 3.1% for the 12 months ending in July, and that is up from 2.9% through the 12 months ending in June. So CPI, core CPI is rising. The CPI increase is being restrained by a decline in energy commodity prices, which includes gasoline. I do not expect a rise in commodity prices will materially pressure CPI higher for as long as OPEC continues to flood the market with excess supply in a bid to increase market share at the expense of U.S. shale producers, which is what they are doing now. U.S. field crude production is declining this year. This drill, baby, drill mantra that you hear from politicians is just garbage. Look at the numbers. You can find the weekly numbers of U.S. field production by Googling EIA weekly field production. In January 2025, the U.S. weekly field production numbers were over 3.4 million barrels per day for every week in January 2025 and have fallen now to 13.284 million for the week ending 8/1. That is the last reported weekly number by the Energy Department. EIA reports are expressed in thousands of barrels. The CME FedWatch tool currently has the odds of a 25 basis point cut in the FF rate at 94%. That would be at the mid-September meeting, and if it occurs, and it's almost 100% odds that it will take the FF range down to 4% to 4.25%, and will result in less interest income for me and other savers as well. Trump has claimed repeatedly and recently that the economy is booming. He will put in his Truth Social post the word booming in all cap letters. He made that statement when he fired the BLS commissioner and also when he announced the nomination of her replacement a guy that I discuss in today's blog, I am not impressed and have no confidence in his ability to accurately report the data. If the economy was booming, there would not be any need to reduce the federal funds rate from the current range of 4.25% to 4.5%. That would be particularly true with core CPI prices continuing to rise. Stimulating the economy, unless we've forgotten, when inflation is rising has only recently proven to be a disastrous monetary policy. The Fed kept ZIRP and QE in place during 2021 and to March 2022 when inflation was surging, hitting a 12-month increase of 8.5% through March of 2022. And then when the Fed increased the federal funds rate that month, it only did so by 0.25%, and it continued quantitative easing by reinvesting most of the proceeds from maturing treasuries and mortgage-backed securities that it owned. A return to problematic inflation will have a far worse result for U.S. consumers and the economy than a slight rise in the unemployment rate, and would eventually trigger higher unemployment anyways as consumer spending eases in response to rising prices. And I'm talking about a real consumer purchases, not as adjusted for prices adjusted for inflation. So the volume would go down. I also discussed some policy and legal issues unrelated to my investments in today's post, which is my custom. You can simply avoid them. They're segregated from the discussion about my investments and the economy. I wanted to mention one of the discussions here, and it involves the district court judge denying the DOJ's motion to release the grand jury transcript and the New York criminal case against Epstein and Maxwell, as I predicted a month ago in a YouTube video that I will link in the More section below. The court characterized the DOJ's reasons for releasing the transcript as, quote, demonstrably false, end quote. The court also noted, as Trump and Pam Bondi had to know, that there were only 2 law enforcement witnesses during the grand jury who simply relayed the results of their investigation to the grand jurors. So even if the testimony had been released, as the court noted in his opinion, nothing material would have been added to what is now known about the sex trafficking of underage girls by Epstein and Maxwell. What is not known is the information in the Epstein files that Trump and Bondi have secreted from public viewing. And I don't think Bondi will be testifying anytime soon before Congress, because she will be asked whether she told Trump that his name appeared throughout the Epstein files or several times in the Epstein files, and then a decision was made to keep the files secret.